There's a lot of bets right now that we're actually going to see record highs for the S&P next year, that stocks are on a tear the rest of this year, and it's going to continue into 24. RBC is joining these bullish calls, forecasting that we could reach 5,000 by the end of 2024. But does that mean that a soft landing has to happen first? I want to bring in QI Research CEO and Chief Strategist Danielle DiMartino Booth. Danielle, always great to speak with you. Great to see you today. So you believe that we're in for another leg up in the coming months, but that you think we might be getting ahead of ourselves just a little bit. Explain your position.
So as of the month of October, the most recent jobs market data that we have for the country, we know that in 50 of the 51 states, including Washington, D.C., the unemployment rate is rising. And typically in history back to 1976, as long as this series has existed, when you do have 50 of the 51 states with rising unemployment rates, you do see markets rally initially those first and second months ahead of the national unemployment rate turning up. Without exception, we've always seen a negative non-farm payroll print. That would be for the month of November coming up. But again, markets are going to enthusiastically say, gee, the Fed's going to pivot. And that's reason for us to rally into this initially bad news.
It's interesting that you say that. You know, a lot of folks are eager to see this rate cut sometime next year. I think it's about a 30% bet right now that we're going to see a rate cut in the month of March. Traders have the ability to be optimistic. You can say maybe that's too optimistic. But you say, look at the Fed's balance sheet. Even if you got a 100 basis point cut, they'd still be tightening. Explain how that's working in your mind.
Well, what we're seeing with the Federal Reserve, and the reason that so many Americans they know of a company or a company in the neighboring town where the factory's closing. We're seeing bankruptcies roll in at the fastest pace since 2010. So most Americans are aware that the recession is setting in and that this is going to be met with presumably rate cuts by the Federal Reserve. But it's the pulling of the liquidity out of the system. It's the inability for companies to access financing. That's a reflection, Cheryl, of the Federal Reserve shrinking its balance sheet. Having there be less liquidity in the system makes it more difficult, whether you're talking about a mom and pop small business or a very large corporation, to access financing to stay alive. And that's what we're going to continue to see. Even if the Fed starts lowering interest rates, Jay Powell's been very forthright in saying we're going to continue shrinking that balance sheet. Yeah,
and we've had some commentary from Fed officials as well, kind of pointing to that. And you have to wonder at what point do they say, okay, enough is enough. When you've got core still sitting at 4% and their target is 2%. I've heard a lot of commentary that says they really need to adjust their inflation targets. That's just my opinion, though, Danielle. You know, the Southern girl that I am, as you are. Great to see you, Danielle. Appreciate coming on the show today.
Likewise. Happy Thanksgiving, Cheryl.
Happy Thanksgiving to you. All right.